Cheryl Casoni is on it right now, waiting on these numbers to see a market move. Over to you, Cheryl.
Wow, 9.1% year over year, much hotter than expected, everybody. 1981, November 1981 is the last time that we have seen an inflationary number this high for CPI. Again, 9.1%. There you go, folks. That is the big story here.
U.S. consumer prices in June accelerated at the fastest annual pace since November at around the same time in 1981. Still a 40-year high, and at the pace the feds are going and selling us that they have this under control and that they are doing the best that they personally can do, I call bull. Say it for me, Mr. Kevin Samuels.
That is bullshit.
Okay, let's get back to this headline news from Yahoo Finance. The Bureau of Labor Statistics Consumer Price Index, the CPI, reflected a year-over-year increase of 9.1% last month. Remember, guys, this is their calculation. And if they are forced by their calculation to report this number, I will double the real number. I would believe that the real numbers are horrific. Double them. Thank you, Joe Biden. You and your administration are doing a phenomenal job.
That is bullshit.
This number is up from prior 40-year high of 8.6 in May. Economists were expecting June's reading to show a conservative 8.8 increase, according to the estimates compiled by Bloomberg. Yeah, don't bet on that. I would say a 1% basis point is expected on July 26th and 27th after the FOMC meeting, coming together on these dates at the end of July. But I digress. Let's see what's going on and check out more information from the mainstream media. Editor, roll clip, fair use.
Headline CPI rose 9.1% in the month, raising fears in the markets of a more aggressive pace of rate hikes from the Federal Reserve. Let's bring Yahoo Finance's Brian Chung on this. Brian, double-barreled question. One, what drove some of these increases, and what are the implications for the Fed's next move?
Yeah, so let's start off with the first bit of that. Again, if we unpack the numbers that we got about 30 minutes ago from the Bureau of Labor Statistics, you can see on a year-over-year basis, prices increased in America by 9.1%, above the street's estimates of 8.8%, so a hotter than expected report. Again, that's the hottest pace that we've seen since November of 1981. On a month-over-month basis, prices increased by 1.3%. Now, the Fed might argue, let's take a look at the core CPI, which strips out those more volatile components like, for example, food and energy. And when you take out those elements, you do see a lower inflation report of 5.9% on a year-over-year basis, 0.7% on a month-over-month basis. But of course, you're going to have a lot of Americans saying, well, food and energy are the most important parts of my daily consumption, so why would we strip that out? And indeed, when you do look at the prices of gasoline, fuel oil, things that Americans were spending a lot of money on in the month of June, you did see increases on a month-over-month basis, 11.2% on gasoline. Fuel oil did decline by 1%. Food, though, increased by 1%. You take a look at some other components of the CPI as well. Interesting to see the reopening play. Actually saw some prices decline. Hotels and motels down over 3%. Airline fares, car and truck rentals down about 2%. But take a look at owner's equivalent rent. This has been an argument for the more delayed bleed into higher inflation, increasing by 0.7%. That shows an acceleration, actually, of inflation in what is a very large percentage of the average household expenditure, guys.
Is there anything that we can extrapolate this to really show where consumers are pushing back on the prices that they do have to pay right now?
Yeah, certainly. I mean, there is demand destruction in some of those larger durable items. When you take a look at TVs, for example, declining by 2.3% on a month-over-month basis in this report. But again, you look at that headline number, yes, you can maybe make it look a little bit better by taking a look at the core number, but it is still hot, whether or not you look at a core reading or a headline reading. So across the board, there is still a lot of demand. A lot of companies that are supplying either services or goods are continuing to raise prices as of the month of June. But keep in mind, the price declines that we saw, at least in what you see at the pump, didn't start to happen until a few weeks ago. So that really isn't reflected in this June report. That's a reason why you have some economists saying the July report could show signs of perhaps some easing. But look, from the report we got 30 minutes ago, you're not seeing that quite yet.
When I look at this report, I don't see any relief anywhere. Even before we got to this 9.1%, there had been some sectors that were behaving a little bit better. I look at rents going up. I didn't see any relief in apparel. There was some hope, folks, that maybe with the inventory that Courtney Reagan's been talking about at some of the department stores, that you might see some relief in apparel. Not much there. I did see airline fares go down 1.8%. I don't even know what that means. I'm sure it's not going to hang on there. I guess the only question is you had double-digit 11%, 12% increases in energy. As to whether or not some of that comes off the boil in the future, given what's happened in gasoline futures markets, that they've come down by nearly $1, at least from the peak, whether or not and how that shows up and when that shows up in the consumer price is really a question. But overall, you have this unrelenting increase in prices from varying degrees, from 0.7 on rent up to 1% on food. And there's every reason to think this would make the Fed tougher right here, Andrew.
Steve, thank you for that. I want to get over to Mike Santoli, who's watching the stock market as well. What's your take here, Mike?
Yeah, pretty linear in terms of all the things Rick and Steve were talking about and how that feeds into equity prices. There's an impatience inherent in the equity market to try to look for the turn, to look for this sequence of better numbers that's going to allow us to believe both peak inflation is in place and then that the Fed can therefore possibly ease back. And so what do we need for that? Well, the Fed has told you it needs a sequence of month-on-month declines in core inflation at least. You have to kind of restart the clock when you get a hot number like this, and that's where we are at this point, essentially not being able to price in that relief. The bond market volatility has been searing recently. I mean, if you look at any indication of it, as well as currency market volatility. Equity market volatility has been actually more muted, but it really can't fully calm down. The stock market can't really fully get away from the macro pressures and maybe focus on whether earnings are priced in or not until you do see those other kind of fixed income and currency markets maybe settle down a little bit.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the bull coming from the economy and their calculations. Say it again for me, Mr. Kevin Samuels.
That is bullshit.
So I don't get into any trouble, because this is getting crazy. Every time I fill up my tank, I let out an oh my god. Editor, video.
Oh my God!
Guys, it's going to get worse before it gets better. Do your own research and just price this in to your budget. Prepare. I'll continue to do my best and bring you the information as it unveils. Thank you guys for all your support, likes, and comments. Share these videos and stay free.
It ain't hard to tell. I excel, then prevail.